6 things I wish I knew before I ever started investing. Number 1, let's get right into it. Number 1, take the emotion out of investing. Because here's the thing, you're going to get to a period real quick where you're going to get euphoric. The markets are high. You've made a ton of money. You're going to want to just continue to buy and buy and buy. You're going to want to leverage. You're going to want to borrow money from your parents. You can't lose. Well, that's usually the time when you will lose. And then the opposite will happen. At the bottom, you're going to think, I cannot make money. It's impossible. I lost everything. My life is ruined. I hate investing. Why did I even do this? If you remove the emotion from investing, you're going to know that at the top and at the bottom, at the top, if you look at multiples, if you look at historical averages, you're going to see that it might make sense to trim. And at the bottom, you're going to see that while no one's getting in, it makes a ton of sense to get in. Number 2, don't change your investment goals just because the markets are volatile. It does not make sense to say at the bottom of the market or at the top of the market that you're going to take a different approach to investing, or that you're going to invest a different sum of money, or that you're going to take a different asset allocation. The reason you make a prudent, comprehensive, and structured plan is so that when you hit periods of instability, either a crash or a euphoric kind of everyone's making money type moment, is so that you don't change your mind about that. You make a plan and you stick to it, because history has proven that those who make plans and those who are disciplined and those who stick to it will do better, because you're going to be tempted to sell at the bottom. You're going to be tempted to buy more at the top. You're going to be tempted to buy assets that have outperformed. You're going to have a recency bias. You're going to look at assets that have done really well in the last 6, 12, and 18 months. And that's probably not the best time to get into them. You're going to want to shun investments that have performed terribly in the prior 6, 12, 18 months. If you change your plan and you go, you know what? I know I said I would have growth and value, and I know I said I would have Canada, US, and global, and I know I said I would have stocks and bonds, but I'm going to make some changes because this is a specific situation that merits a change. No, not a good idea. Stick to your plan. Number 3, don't forget to take profits. You bought a stock, you made a ton of money on it, trim it prudently on the way up. There will be an asset class, a sector, or a stock that will make more money than the others. It always happens in every market cycle, whether it's commodities or oil and gas or gold or bank stocks or growth stocks or tech stocks. There will be a piece of your portfolio, if it's well diversified, that will return better than others. As it's starting to outpace its allocated weight, take some profits, prudently trim those assets and take some money off the table. It doesn't mean you need to sell the whole thing, but it certainly means that you should trim and take some money off the table. If the asset class corrects again, you'll have cash, you'll have an opportunity to buy some more again. Don't forget to take profits. Number 4, what goes up must come down. So if you own quality stocks, if you own stuff that has a long-term proven track record, good management, strong balance sheet, strong corporate earnings that are growing consistently year in, year out. So I'm talking about, blue chip companies, large cap companies that are not speculative. They will go up, but here's the thing, they will unequivocally go down. You cannot go through a period, you cannot own securities without going through a period where there will be corrections. You're going to have a piece of time. There will be a time in your life where you're going to be down 30 or 40% on a specific stock or on a specific sector. It will happen unequivocally. One thing I know is I don't know when it's going to happen. And another thing I know is it will happen. Maybe it's in 2 years and 3 years and 4 years. I don't know, but there will be a time where it's going to drop. Does that mean you sell the asset? No. And obviously, here's the other thing. You're not going to know when it's going to happen. In hindsight, you're going to kick yourself. You're going to say, I should have seen that coming. I should have known that. But in reality, you didn't, you couldn't, and it's not your fault, okay? These things blindside you. Why? Because they trade on emotion and they don't trade on a rational basis. Number 5, the market doesn't care what you paid for your security. So stop caring about it so much. It doesn't matter if you bought a stock at $10 or $50 or $100. What matters is what is happening today, and is that company worth that amount today? Things have changed, management has changed, the global market situation has changed, or maybe the whole sector has changed. It's irrelevant what you paid for a stock. So if ever you hear yourself saying, I'll just wait for it to come back to the price I paid for it before selling, Stop yourself right there. It's a fallacy and it makes no sense. Why should that number matter? It doesn't matter. It only matters in your head. And that's a bad way to make decisions because it's completely irrelevant to the matter at hand, which is what is that company really worth? If the stock today is worth $40 and it's trading at 35, sell it when it hits close to $40. It's irrelevant if you paid 50 for it or if you paid 20 for it. The market doesn't care what you pay. Finally, number 6, seek advice. There's nothing wrong when it comes to this, when it comes to building portfolios, in working with professionals, because this is a very, very tough area. So whether your advice is from your mom or your dad or a buddy or a cousin or an uncle when you're starting out, that's an absolutely good path to take. And as your wealth grows over time, look at an advisor. And, once you hit, $250,000 of investable assets, you should be looking at working with your own portfolio manager who could build you a custom portfolio for your needs, for your liquidity, for your time horizon, and for your risk aversion. So that's a critical part to all of this, is seeking the right advice. Thanks so much for tuning in, guys. Don't forget to book a no obligation consultation. Go to www.speaktorob.com. We'd love to do that for you. I'm Rob Tetrault. See you in the next video.